Imagine you're a sovereign nation, right?
Mm,
And you are facing this massive, just unprecedented tsunami of foreign money.
right. Billions of dollars.
Yeah, billions washing over your borders every single day.
Yeah.
And it's threatening to completely drown your domestic economy.
Oh, absolutely.
It artificially inflates your currency. It destroys the competitiveness of your exports. So what do?
You try to build a wall.
Exactly. You build this massive, towering defensive wall to keep it out. You lay the bricks of regulatory legislation. You pour the concrete of heady taxation.
Yeah.
You stand on the battlements and you declare, your sovereign borders are secure. But, and here's the hook, what if that wall actually acts as a giant neon sign?
A neon sign screaming, "Come on in, the party is amazing."
Yes, a VIP fast pass lane. So today we're doing a deep dive into the absolute thick of a survival battle for emerging economies.
That's a fascinating topic.
It really is. We usually think of government regulations as a hard stop sign, right?
Yeah. A non-negotiable barrier.
But we're about to see how transnational capital markets, they don't look at regulations as stop signs at all. They treat them as starting guns.
They really do. It's the ultimate counterintuitive paradox of the modern global financial system.
Yeah.
The very act of a government trying to lock the door and keep the money out, it serves as definitive proof to the international markets that you have something inside that is incredibly valuable.
Something worth breaching the walls for.
Exactly.
So to set the scene properly, we need to go back to 2008.
2008, the crash.
Right. The global financial crisis is erupting. Wall Street is functionally on fire. London is freezing up.
Yeah, credit markets just stopped.
And there's this trillion-dollar tidal wave of what economists call hot money.
Which is basically highly liquid, speculative global capital.
Right. And it's frantically searching the globe for yield because the traditional safe havens are collapsing.
It's looking for anywhere that still has a pulse, basically.
Yeah. And governments around the world are watching this wave approach, and they genuinely believe they hold a remote control to their own economies.
They really thought they could just flip a switch and block offshore hot money.
But history shows, and this is what we're going to unpack, that the breakwaters these governments build are entirely ineffective.
Totally ineffective. The historical reality, backed by some incredibly granular data we are about to look at, shows they often function as those VIP lanes you mentioned.
Yeah, and that brings us to the core material for today's deep dive. We are looking at a truly groundbreaking study by researchers Yathin Gingerak, Ilan Noy, and Huan Zhang.
A fantastic paper.
It really is. What they did was analyze 5 massive, dramatic shifts in Brazil's capital control policies.
Right, between 2008 and 2011.
Yeah. And this specific study is a landmark piece of research because it completely strips away all the macroeconomic noise.
It isolates the variables perfectly.
It does. It reveals this mind-bending secret about how global finance actually operates on a psychological level.
By the end of this deep dive, pretty much everything you thought you knew about how governments control their economies is going to be turned upside down.
A total slap in the face to basic economics.
It requires a fundamental subversion of how we intuitively think about cause and effect.
Yeah, because if you approach this with basic economic common sense.
The idea that raising the price of something decreases the demand for it.
Right. If you think like that, you're going to be completely lost here.
We're going to dismantle that assumption entirely using pure empirical evidence.
Okay, let's start with the international referee in all of this. The International Monetary Fund.
The IMF.
The mighty IMF. For decades, they fiercely opposed any controls on capital.
They were essentially the high priests of the free market.
Right. Their orthodoxy was absolute. You do not block the free flow of money. Ever. Capital mobility was the holy grail.
Yeah, the Washington Consensus.
But then, right after 2008, the IMF suddenly executed this massive, unprecedented U-turn.
It was shocking.
They actually started encouraging these exact types of capital controls.
Right.
To fully appreciate how wild that is, we need to understand what forced the most orthodox financial institution on Earth to suddenly change its religion.
Well, in a word, panic.
Panic.
Pure, unadulterated, systemic panic. You have to remember the historical posture of the IMF throughout the 80s and especially the 90s.
Right. Pushing for total frictionless financial liberalization.
Exactly. They told emerging markets that if they wanted to grow, they had to open their capital accounts completely.
But the 2008 crisis was just, it was a shock of such terrifying magnitude.
All those old orthodoxies collapsed under the weight of reality.
Yeah.
When the U.S. Federal Reserve and other major central banks slashed interest rates to basically zero and started quantitative easing.
Essentially flooded the world with cheap money.
Right. And that money didn't just sit in American bank accounts. It became that hot money rushing across borders into emerging markets like Brazil, China, India.
Looking for higher interest rates.
Yeah.
Because if you can borrow money in the U.S. at basically 0%, right? And Brazilian government bonds are paying, what, 10 or 12%?
Something like that, yeah.
That is an irresistible arbitrage opportunity. You just borrow in dollars, convert to the Brazilian real, buy the bonds, and print money.
It's the classic carry trade.
Yeah.
But that creates massive destabilizing asset bubbles in the emerging economy.
Right. Their currencies appreciate wildly.
Which destroys their export industries. Things get too expensive to sell abroad.
And the truly terrifying part for these governments is the reversal, right?
Exactly. Hot money is incredibly fickle.
Yeah.
The moment global sentiment shifts, that trillion-dollar wave pulls back out just as violently as it crashed in.
Leaving the domestic economy in absolute ruins.
So the IMF watched this dynamic playing out in 2008 and realized their old rule book was functionally a suicide pact for these nations.
So they flipped.
They officially began recommending that countries facing a sudden surge in capital inflows should impose capital controls as a temporary last resort.
Basically, taxes or limits on incoming foreign money to protect themselves.
Right.
But the central question of this study, and this is where the data really slaps you across the face, is whether this new medicine actually cured the disease.
And the data reveals that it absolutely did not.
It was essentially a sugar pill that occasionally acted like poison.
Yeah.
And to prove this, the researchers didn't rely on broad, subjective macroeconomic theories, did they?
No, they didn't look at annual GDP or yearly foreign direct investment. That's too slow.
Right.
They zoomed way in. They used highly granular microscopic data known as EPFR data.
Tell us about the EPFR data. This is crucial.
Yes, the choice of data set is what makes this study bulletproof. EPFR stands for Emerging Portfolio Fund Research.
Okay.
In the world of quantitative finance, this is the ultimate follow-the-money tracker.
Got it.
Historically, if economists wanted to study capital flows, they had to look at balance of payments data, which governments publish maybe quarterly.
But a quarter is an eternity in financial markets.
Exactly. A crisis can begin and end in 3 weeks. EPFR data, on the other hand, tracks mutual fund and ETF flows on a weekly and sometimes daily basis.
Oh, wow. So it's real time.
It captures exactly where institutional investment funds in Europe and the U.S. are allocating their cash.
So if a portfolio manager sitting at a desk in New York clicks a button on a Tuesday afternoon to move $50 million out of U.S. Treasuries and into Brazilian corporate bonds.
The EPFR dataset catches that specific ripple almost instantly.
That's incredible.
It allows researchers to observe the immediate, unfiltered reaction of the smartest money on Earth to government policy announcements.
It completely removes the guesswork.
We don't have to theorize about how markets react to a new tax. We can literally watch the capital shifting across borders week by week.
And when we look at that movement, we collide directly with traditional economic theory.
Head on.
The textbook law of demand states that if a country imposes a tax on incoming money, that money should slow down. Basic physics. If Brazil says, we're going to take a 2% cut of any money you bring into our country, the yield drops, and rational investors should theoretically look elsewhere.
That is the bedrock of every first-year economics textbook.
But the empirical evidence here shows that moderate, price-based taxes, a percentage fee levied on the inflow, do absolutely nothing to reduce the total volume of money flooding in.
They are completely mathematically ineffective at stemming the tide.
Which raises a massive question. If the microdata proves these taxes don't work, why did the world's top financial minds at the IMF suddenly start recommending them?
Again, desperation.
Yeah.
When a sovereign nation is watching its currency appreciate by 20% in a matter of months, hollowing out its manufacturing sector, the government demands a solution.
The IMF needed a tool to offer them.
But in recommending these price-based controls, they failed to account for the supreme agility and complexity of modern financial markets.
Okay, and we should point out here, this specific mechanism, the debate over capital controls, is deeply embedded in political philosophy.
Oh, heavily.
There are vocal factions who view these controls as the only legitimate defense against predatory, speculative foreign capital.
Right.
And there are equally vocal factions who view them as disastrous market interventions that destroy efficiency.
And we need to be clear, we are entirely neutral here.
Absolutely.
Yeah.
We aren't here to endorse the virtues of the free market or the necessity of government intervention. We are acting as referees, looking solely at the scoreboard.
And what the scoreboard reveals is that the medication prescribed by the global financial establishment had a 0% efficacy rate.
Right. But proving that a policy did nothing is actually incredibly difficult in economics.
It is.
Because if Brazil passes a tax and capital keeps flowing in, a politician can just argue, well, the flow would have been twice as massive if we hadn't passed the tax. The tax worked, it just mitigated a worse disaster.
That's the classic political defense.
So how do you scientifically prove that the policy was useless?
You need a control group.
In medicine, you run a clinical trial. You give half the patients the real drug and half the patients a placebo.
Right.
But you can't exactly clone the nation of Brazil, give one the tax policy, and leave the other one alone.
In the physical world, no, you cannot. But in the realm of advanced statistics, you absolutely can.
And this brings us to the methodological brilliance of this study.
Yes. The researchers refused to rely on subjective guesswork to determine what would have happened if Brazil hadn't passed these laws.
Guesswork is the enemy of rigorous science.
Exactly. Instead, they utilized an advanced econometric technique called the synthetic control method.
They literally cloned a synthetic Brazil.
They did.
This concept is fascinating to me. It's like firing up a parallel universe machine. Break down how this Frankenstein nation is actually constructed. How do you synthesize a country?
Okay, so the synthetic control method was originally developed to study the economic impacts of localized events.
Like what?
Like how a specific terrorism event affects a single region, or how a new tobacco law affects a specific state.
Okay, got it.
To build synthetic Brazil, the statistical algorithm searches through a large pool of other emerging market nations.
Right.
Crucially, it only looks at nations that did not change their capital control laws during the period being studied.
Oh, that makes sense. They have to be clean control subjects.
Exactly. The algorithm then automatically assigns specific percentage weights to these other countries to create a mathematical composite.
Okay.
The goal of this composite is to perfectly mimic the real Brazil's economic behavior, specifically its capital inflows, its exchange rates, and its equity market returns in the 12 weeks leading up to the policy change.
So it stitches together this bizarre, invisible baseline country.
Right.
It might take a massive chunk of China's economic data, blend it with a slice of Russia's, add a dash of India, and weigh them all together.
Yes, exactly.
And this mathematical construct behaves identically to the real Brazil right up until the exact moment the Brazilian finance minister steps to the podium to announce the new tax law.
Precisely. By matching the pre-policy data flawlessly, the researchers create an alternate timeline where the policy intervention never happened.
Wow.
In statistics, the algorithm minimizes what's called the root mean squared prediction error.
Okay, no academic jargon. What does that mean in English?
Fair enough. It basically means the algorithm adjusts the recipe of the control countries over and over until the line tracking synthetic Brazil perfectly overlaps the line tracking real Brazil for months before the event.
Okay, so if they overlap perfectly before the shock, we can confidently assume synthetic Brazil represents what real Brazil would have done if the government had just sat on its hands.
Exactly, if they pass no laws at all.
That sets up the perfect collision course. We now have our two timelines clearly mapped out.
Real Brazil and synthetic Brazil.
Right. Real Brazil is about to throw up massive, desperate tax walls to block the hot money. And synthetic Brazil does absolutely nothing. The researchers tracked these two timelines across 5 distinct historical moments, or acts, of policy changes. Let's dive into the first collision. Act 1, March 2008.
The erection of the symbolic wall.
Let's look at the macroeconomic pressure building up at this moment. What's happening in March 2008?
The global markets are deeply uneasy. Bear Stearns is collapsing in the United States.
Right.
But for emerging markets like Brazil, the problem isn't a lack of money, it's an overwhelming flood of it.
Because global investors are desperately pulling their cash out of American financials.
And dumping it into commodities and emerging market debt, which were booming.
Brazil's currency, the real, is appreciating rapidly against the dollar because so much foreign capital is buying reals to invest in Brazilian high-yield bonds.
Yeah, and the Brazilian government realizes this currency appreciation is going to crush their exporters. So they decide to act.
They slam down a 1.5% penalty tax specifically on foreign fixed-income investments.
Formerly known as the IOF tax, they are trying to build a wall to stop the flood.
Now, the logic seems sound on paper. If a hedge fund wants to buy Brazilian bonds, they now have to surrender 1.5% of their principal to the government right at the door.
You'd think that would immediately redirect the water.
But it didn't. The money barely even blinked. And what's even crazier is that the smartest money on Earth had already perfectly outmaneuvered the move half a month earlier.
This is where the EPFR data reveals an incredible dynamic about the speed and foresight of transnational capital.
Tell me.
When you look at the weekly fund flows, before the 1.5% tax was even officially announced by the Brazilian government, the money was already flowing in at an accelerated rate.
Wait, they knew it was coming.
The financial markets possess highly sophisticated intelligence networks. They watch central bank reserves. They analyze political rhetoric. They monitor local media.
So they knew the wall was being built before the bricks even arrived.
Exactly. So they accelerated their inflows to beat the deadline. By the time the tax officially went into effect, a massive chunk of capital was already safely inside the country, totally untaxed.
That really highlights the severe disadvantage sovereign governments operate under. They move at the speed of bureaucracy, drafting legislation.
While capital moves at the speed of fiber optic cables.
Right, so the tax hits. Does it at least stop the new money from coming in?
Barely. For the transnational capital leviathans, a 1.5% defensive tax bought the Brazilian government exactly 1 month of hesitation.
Just 1 month.
For a few brief weeks, the real capital inflows into Brazil dipped slightly below our baseline, the synthetic Brazil timeline.
Okay.
But within roughly 4 weeks, the real money curve merged right back up with the synthetic no-tax curve, and then both kept skyrocketing together.
How is that mechanically possible? A 1.5% tax is a significant haircut for an investment fund that might only be targeting a 6% or 7% annual yield.
Yes.
Did these funds just decide to eat the cost and accept lower returns?
Well, a few might have, particularly long-term institutional players who don't trade frequently. But the vast majority of the hot money just bypassed the rules entirely through regulatory arbitrage.
Loopholes.
Exactly. You have to remember, the tax was narrowly targeted only at fixed income investments, government bonds, and corporate debt.
So what does a nimble hedge fund do?
They simply shift channels. They redirect their inflows into the Brazilian equity market, buying stocks, which were still completely tax-free at that point.
Oh, wow.
Once the money is legally inside the country via the stock market, it's very easy to restructure the exposure internally.
Or they use the offshore derivatives market, right? Which is the ultimate loophole.
Oh, absolutely.
Like if I'm a hedge fund in London and I want exposure to Brazil's high interest rates, but I don't want to pay the 1.5% border tax, I don't actually buy the Brazilian bond.
No, you don't.
I go to an investment bank in London and enter into a total return swap, or a non-deliverable forward.
Exactly.
I essentially place a side bet with the bank on what the Brazilian interest rate will do. The bank pays me the yield of the bond, I pay them a fee, and the actual underlying capital never physically crosses the Brazilian border to trigger the tax.
Yep. The wall is entirely an illusion. It's a chain link fence trying to hold back a flood. The water just flows through the gaps.
The sheer impotence of price-based controls in a sophisticated financial market is staggering.
The capital markets employ armies of the best quantitative analysts and regulatory lawyers in the world. Their entire job is to find the gaps in the chain link fence.
They will engineer a synthetic instrument to bypass a 1.5% wall before the ink on the government's legislation is even dry.
Precisely.
So Act I proves that building a wall to keep the water out is a total failure. The market casually walks around it.
Right.
But then the macro environment shifts violently. We enter Act II, October 2008, the Great Retreat.
The world changes almost overnight.
September 2008, Lehman Brothers collapses. The global financial system freezes entirely.
Suddenly, it is no longer a wave of money frantically rushing into emerging markets. It transforms into a massive, violent undertow pulling money out.
Global investors are facing margin calls.
They are panicking, and they are indiscriminately liquidating their emerging market assets to raise U.S. dollars. Capital is fleeing Brazil in an absolute panic.
Brazil is hemorrhaging cash. The real is plunging in value. The central bank is burning through foreign reserves trying to defend the currency, but it's not enough.
The government is desperate to stop the bleeding.
So what do? On October 23, 2008, they take the wall down.
Yes.
They urgently cut the IOF tax on fixed income inflows all the way back down to zero. They completely eliminate the penalty for entering the country.
And here's where we encounter a massive statistical anomaly that breaks every rule of basic behavioral economics.
Let's clearly define the paradox here. In Act I, the government builds a wall to keep water out, and the water ignores it and comes in anyway.
Right.
Now, in Act 2, the water is frantically fleeing the country, the building is on fire, and everyone is running for the exits.
Yeah.
The government responds by making it cheaper to enter the burning building, and somehow that stops the people inside from leaving.
It sounds absurd, but that is precisely what the data dictates.
How does dropping a tax on incoming money stop money from flowing out?
This is what we can call the miracle tourniquet.
Okay, show me the parallel universe.
Right, let's look at synthetic Brazil, the timeline where Brazil did not cut the taxes to zero, where the algorithm assumes they just left the 1.5% tax in place.
What happens there?
Capital plummeted off a cliff. It was a catastrophic vertical bleed out of foreign investment.
Like a waterfall.
Exactly. But in real Brazil, the timeline where the government eliminated the tax, the bleeding miraculously slowed down.
Wow.
The outflow was significantly mitigated. The exchange rate stabilized remarkably well compared to the synthetic baseline.
But hold on. Any skeptical listener is going to immediately push back on this.
As they should.
Lehman Brothers just collapsed.
Yeah.
The entire global banking sector is on the brink of insolvency. A 1.5% tax cut on Brazilian bonds is not going to suddenly convince a panicking hedge fund in New York to keep its money in Latin America.
Right. The whole system is deleveraging.
Could this stabilization in Brazil just be a random statistical fluke? Maybe Brazil's commodity exports happen to have a good week, or maybe the algorithm just got it wrong.
That is exactly the right instinct, and the researchers anticipated that exact critique. You have to ask, was this just a random fluctuation, or was it a statistically significant causal effect of the policy change?
So how did they prove it wasn't luck?
They deployed what are called placebo tests or permutation tests. This is where the methodology gets truly ironclad.
Explain now.
They took the exact same mathematical simulation and ran it on dozens of fake control countries in the data set.
Okay.
They essentially pretended that other countries, let's say South Africa, Mexico, or Indonesia, passed that exact same tax cut on that exact same day in October 2008.
So they gave the sugar pill to everyone else in the data set to see if they would miraculously heal too.
Yes. They generated synthetic control groups for all these other nations, created the fake policy shock, and looked at the deviation between the fake reality and the baseline.
And what happened?
Out of all those dozens of placebo timelines, real Brazil's survival line bursts out from the bottom of the pack.
Really?
The gap between Brazil's real outcome and its synthetic disaster was immense, far larger than any random variation seen in the placebo countries.
So it was statistically significant.
At a 5% significance level, yes. The distribution proved this was not a coincidence. Deregulation in the middle of a systemic panic acted as an incredibly potent tourniquet.
Taking the wall down actively saved them from a much worse capital flight.
It did.
Okay, this is genuinely melting my brain. Making it cheaper to get in somehow convinces investors not to get out. It's a psychological magic trick.
It is.
But we're going to put a pin in exactly why this psychological trick works until we get to the core theory of the paper later on.
Sounds good.
Because right now, the Lehman crisis eventually passes, the global central banks flood the zone with liquidity, and the Brazilian government seems to completely forget the lesson they just learned.
Yeah, they really do.
We move into Act 3 and Act 4, which we can call the gambler's spiral. Act 3, October 2009.
By October 2009, the acute phase of the global panic has cooled off. The U.S. Federal Reserve is executing its first round of quantitative easing, printing money at an unprecedented scale.
Consequently, the hot money returns to the globe, hunting for yield once again.
And it heads straight back to emerging markets, with Brazil being a prime target.
And the Brazilian government, watching the real appreciate rapidly again, decides to drop the hammer.
But this time, they try to plug the loopholes.
Right. They implement a 2% tax, and they apply it broadly, not just to fixed income, but to equities as well.
They are trying to block the stock market backdoor.
So does a broader, heavier tax finally build a functional wall?
The exact opposite occurs.
What?
The foreign capital doesn't retreat. It goes into an absolute frenzied buying spree.
A frenzy. They tax it, they make the asset definitively more expensive and harder to trade, and the investors buy more of it.
Yes. The data shows the real cumulative capital inflow slope becoming extremely steep, rocketing far above the synthetic no-tax timeline.
It outpaces the baseline.
Massively. The prediction error was 101.242. Real inflows showed a completely rare surge post-policy.
You have to unpack the profound psychology happening here. What is the intoxicating allure of the iron fist?
It's fascinating.
Why did slapping a 2% penalty on the money make the money want to get in even faster? From a pure spreadsheet perspective, the expected return on the investment just dropped by 2%.
Right.
Why isn't the capital deterred?
Because the capital isn't just reacting to the spreadsheet, it's reacting to the signal the government is sending.
The signal.
Imposing the tax didn't stop the currency from appreciating because the market interpreted the tax as a massive flashing neon sign that said, this domestic economy is so incredibly strong, the internal market is running so red hot that the sovereign government is being forced to actively cool it down to prevent it from boiling over.
Oh, wow. The velvet rope effect.
The velvet rope effect.
Yeah. If you walk past a nightclub and there's no line and no cover charge, you assume the club is dead and the music is terrible.
Okay, I see where you're going.
But if there's a massive bouncer, a velvet rope, and a $100 cover charge just to get in the door, human psychology immediately assumes the party inside must be legendary.
That's a perfect analogy.
The tax isn't a deterrent, it's a premium quality stamp.
That is exactly what happens on a macroeconomic scale. The hot money gladly paid the 2% tax just to get in on the action.
They paid the cover charge.
The tax confirmed to the global hedge funds that Brazil was the place to be. The control mechanism itself proved the asset's supreme temptation.
The market essentially says, if the central bank is this worried about overheating, the growth metrics must be phenomenal. I'm willing to eat a 2% entry fee to capture that growth.
Precisely.
So the government is losing its mind. They try to cool the economy down by throwing water on the fire, but the water turns out to be gasoline.
Which leads directly to Act 4.
October 2010. The gamblers double down. What happens here?
By late 2010, the U.S. is hinting at a second round of quantitative easing, QE2.
More money is about to flood the system.
The Brazilian government is now desperate. The 2% tax clearly isn't working. So what do? On October 4th, 2010, they double it. They hike the IOF tax to 4%.
And 2 weeks later...
2 weeks later, they realize the capital flows haven't even flinched. So on October 18th, they slam it up to 6%.
6%.
And they don't stop there. Remember those derivative loopholes we discussed earlier?
The total return swaps and offshore bets.
The Brazilian government tries to close those too. They impose a 6% margin tax on derivative transactions to punish traders trying to synthetically bypass the border.
They are throwing every single regulatory card they have on the table.
They are deploying draconian, highly punitive price-based controls to suffocate the inflow.
A 6% upfront tax is astronomical in the fixed income world. If your bond yields 10%, giving up 6% on day one destroys a massive portion of your total return.
The spreadsheet math is brutal.
So what happens? Does the 6% wall finally hold?
The result is a resounding, humiliating defeat for the concept of sovereign financial control.
A slap in the face.
The real capital inflow completely ignores the 6% tax. The data shows the gap between real Brazil and synthetic Brazil just widening further.
Unbelievable.
Real inflows keep soaring aggressively above the synthetic universe. The money simply does not care.
It is genuinely staggering. It proves that no matter how high you build the wall, if the structural macroeconomic incentives like U.S. interest rates being at zero or strong enough, the money will find a way in.
And this reinforces the reality of modern financial engineering.
Right.
Even with taxes on equities and taxes on derivative margins, the capital markets will always innovate faster than the regulators.
They will structure investments as foreign direct investment or use corporate intercompany loans.
Or utilize highly complex structured notes issued in offshore jurisdictions that technically avoid the specific legal wording of the Brazilian tax code.
As long as the yield differential exists, the capital will flow.
Oh.
Which brings us to the final act of this specific historical window. Act V, January 2011.
Right.
A new president, Dilma Rousseff, comes into power in Brazil. She recognizes that the 6% tax is an aggressive, somewhat hostile posture that isn't even working, so her administration cuts the tax back down to 2%.
Yes.
What happens when the wall is suddenly lowered?
We see a brief frenetic sugar rush of capital. The investors are excited by the sudden discount on the entry fee, and they rush in.
Okay.
We see a very sharp, distinct spike in the EPFR data, specifically flowing into Brazil, but it is entirely ephemeral.
How long does this last?
Within roughly 3 months, that localized spike is completely swallowed up by the broader macro trends of the global market.
Right, because by mid-2011, the European sovereign debt crisis is starting to heat up.
Global growth is slowing, and commodity prices are starting to peak. The global appetite for emerging market risk begins to wane.
So the localized impact of dropping the tax from 6% to 2% is completely erased by the massive shifting macro tide.
Exactly. The Brazilian capital inflow curve drops right back down and merges seamlessly with the synthetic baseline. The policy change caused a localized 3-week ripple, and then the ocean took over again.
Okay, let's stop and take a breath here.
It's a lot to take in.
It is. Let's look at the totality of these 5 acts. Every single time the government tried to build a wall and restrict the capital, whether it was 1.5%, 2%, 4%, or 6%, the money either climbed over it, dug under it through derivatives, or just gladly paid the toll because the wall signaled that the party inside was amazing.
The tight controls were mathematically useless. 5 distinct tests of tightening all failed.
But the one time the government tore the wall down completely, Act 2, dropping the tax to zero. During the Lehman panic, the money suddenly obeyed. It stopped fleeing. It stabilized.
It's the ultimate asymmetry.
Why do towering regulatory dams fail to hold back the tide, but slightly opening the floodgates during a crisis makes the water instantly obedient?
This is the absolute core thesis of the paper, and it requires us to look past the math and into the psychology of the market. The researchers conclude that in the real world, capital flows are not dictated by the black and white text of a tax law. The market doesn't trade on the spreadsheet.
What does it trade on?
It trades on a concept we can call the signal game.
The signal game. This is where it gets really profound.
Yes.
The tax rate itself was an illusion. It was never actually an economic barrier. It was a political megaphone.
Exactly.
The hedge fund managers weren't calculating the math. They were trying to read the politicians' minds.
Precisely. To understand the signal game, we have to contextualize the political environment of Brazil during this era.
And it's important to note, we are not analyzing this from a partisan perspective. We are entirely focused on how the international financial markets perceive the political reality, because perception dictates risk models.
Right. If a quantitative model in New York assigns a hostility premium to a certain government, that changes how the money moves, regardless of whether that hostility is justified or not.
So what was the market's perception?
Throughout this period, Brazil was governed by the left-of-center Workers' Party. First under President Lula, and then under Dilma. Historically, the international financial apparatus viewed this party with a high degree of skepticism.
They assumed they were hostile.
The baseline assumption among global investors was that a left-wing government would naturally be somewhat hostile to unregulated international finance and would have an ideological preference for state intervention and capital controls.
Okay, so the market psychological baseline is, this government does not like us. They want to tax us. They want to restrict our movement.
Yes, and that baseline creates what we can call the formula of surprise.
The formula of surprise, I like that.
In financial markets, asset prices only move based on new, unexpected information. Because the market already expected hostility from the Brazilian government, imposing a tax, even escalating it to 6%, was essentially priced into their behavioral models.
It was boring.
It was exactly what the market expected a left-wing government to do. Therefore, it provided no new information about the future of the economy.
Because it wasn't a surprise, it had zero effect on the trajectory of the capital flows.
Exactly.
It makes perfect sense.
Yep.
If the weather forecast says it's going to rain, you walk out of your house with your umbrella already open.
Right.
When the rain actually starts falling, it doesn't change your behavior at all. You were prepared for it. So a 6% tax is just the rain the market always expected.
Exactly. But now, apply that formula of surprise to Act 2.
October 2008. Lehman.
Lehman has collapsed. The market is panicking. The expectation is that this historically interventionist government might panic too, and perhaps lock the capital inside the country to prevent it from leaving.
But instead, what does the government do? They completely remove the tax. They eliminate the friction.
That is a massive system-shocking surprise.
An absolute earthquake of a signal.
By voluntarily removing the tax during a systemic crisis, the supposedly anti-market government signaled to the globe, wait, we actually care about providing liquidity to this market. We aren't going to let the financial system burn down just to satisfy an ideological prior. We are pragmatic, and we are willing to help you.
The tourniquet wasn't the mathematical fact that the tax went to 0%. A 1.5% savings doesn't save a hedge fund during a global meltdown.
No, it doesn't.
The tourniquet was the sudden, profound realization that the sovereign government had their backs.
The psychological relief in the market was palpable. The foreign investors looked at the tax cut and concluded, okay, the Brazilian central bank is acting rationally and pragmatically. We don't need to panic and unilaterally liquidate all our Brazilian assets because the government is actively trying to facilitate a functioning market.
The political signal completely overpowered the mathematical reality. The law itself is just a medium for the message.
That is such a powerful framework for understanding global finance. The capital isn't reacting to the policy, it's reacting to the character revealed by the policy.
But the implications of this study get even darker for the sovereign politicians themselves. We need to look at how global macro funds actually view a country like Brazil. Because it turns out Brazil might not even really exist to them.
It's a harsh reality to accept, but it's true. To the massive transnational capital predators, the funds managing hundreds of billions of dollars, the internal domestic policies of a single emerging market often barely register on a fundamental level.
Wait, how can that be true? We just spent the last 40 minutes discussing 5 distinct acts of intense high-stakes warfare over these specific Brazilian tax rates.
They trade the short-term signals, yes, and they arbitrage the specific legal loopholes. But fundamentally, from a top-down asset allocation perspective to a global mega fund, Brazil isn't a unique, idiosyncratic sovereign entity.
What is it then?
It is just one slice of a prepackaged combo meal.
You're going to have to explain the combo meal theory of international finance.
Let's look back at the methodology of the paper. When the researchers built Synthetic Brazil, what countries did the algorithm automatically select to best mimic Brazil's capital flows?
The Frankenstein monster. What were the body parts made of?
In several of the key modeling scenarios, the algorithm assigned a massive weight to China, sometimes as high as 90.3%, and a significant weight to Russia, around 24.4%.
Wait, 90 plus 24 is over 100%. How does that math work?
In synthetic control methodology, particularly when trying to achieve a perfect pretreatment fit across volatile financial variables, the algorithm sometimes utilizes complex offset weightings.
Right.
It might take 90% of China's flows, add 24% of Russia's, and then subtract a percentage of another country to perfectly align the synthetic baseline with real Brazil's historical volatility.
Oh, okay.
But the mathematical mechanics aren't the primary takeaway here. The takeaway is the identity of the dominant forces. China, Russia, India.
The BRIC nations.
The algorithm is screaming at us that Brazil's capital flows are overwhelmingly, inextricably tied to the BRICS nations. The fate resonance of BRICS is absolute.
So what does that actually mean for the money moving around to the real world?
It means that in the eyes of the massive institutional investors, these assets are largely interchangeable.
Interchangeable.
Yes. When a sovereign wealth fund or a massive pension system decides to deploy capital, they rarely say, let's invest in Brazil because the Brazilian finance ministry just passed a very sensible infrastructure bill.
They don't care about the local infrastructure bill.
They say, we need 5% of our portfolio allocated to emerging market commodities and growth to hedge against U.S. inflation. And how do they execute that? They buy the BRICS basket. They buy an emerging markets ETF.
They buy the combo meal.
Exactly.
They aren't tasting the individual ingredients. They don't care if the fries in the combo meal are a little saltier today because Brazil raised a tax. They just want the number 4 value meal because they need emerging market exposure.
Exactly. And because of the sheer scale of passive investing and benchmark-driven capital flows, a tiny idiosyncratic tweak in Brazil's tax code is brutally, effortlessly erased by the massive sweeping momentum of the global BRICS trend.
That's depressing for a sovereign policymaker.
It is. If the macroeconomic environment dictates that the world needs to buy China and Russia, they are buying Brazil simultaneously, regardless of whether Brazil has a 2% tax or a 6% tax. The macro tide is simply too powerful for a single emerging market to resist through moderate taxation.
Which brings us to the ultimate, somewhat cynical conclusion of this entire narrative. It's a question about the ballot box.
Ah, yes.
If advanced econometric science, historical data, and synthetic parallel universes all definitively prove that these moderate price-based taxes are mathematically useless.
Which they do.
If the smartest money easily bypasses them through derivatives, if the psychological signal is the only thing that actually matters, and if the country's destiny is ultimately just tethered to the massive BRICS combo meal anyway, why on earth do politicians keep passing these laws? Why do they keep building walls they know the water will just walk right through?
Because, at the end of the day, the policy is not actually about the economics. It is a highly choreographed show for the voters.
It's domestic political theater. The finance show.
You have to put yourself in the shoes of a politician in an emerging market. You are facing rising domestic inflation. Your currency is appreciating so fast that your factories are shutting down because they can't export anything, and your citizens are angry.
Right.
You cannot stand at a podium on national television and tell your voters the global tides of transnational capital and U.S. monetary policy are simply too big for us, and we are functionally powerless to stop it.
That is instant political suicide. A sovereign government must project sovereignty.
So they pass capital controls not to change the empirical data, but to perform a display of strength to their domestic audience. They are saying, look at me, I am fighting the foreign speculators.
Yes. They are publicly resisting the framework of the IMF. They are standing up to the wealthy foreign bankers in London and New York. It's a theatrical performance of sovereignty.
And the tragedy of this feedback loop is profound. The policy is entirely designed for domestic consumption, engineered to win the next election by projecting a mirage of power.
Meanwhile,
The international financial markets sit in the front row, watch the entire play, completely ignore the actual plot and the legislation, and trade purely on the psychological subtext of the performance.
it's incredible. The politician stands there and says, look how hard I am punching this wall to protect you.
Right.
And the international hedge fund manager looks at the exact same event and says, look how incredibly strong that economy must be if the politician feels the need to punch the wall so hard. I'm going to buy more of their stock.
Exactly. It's a perverse equilibrium. The politician wins the domestic vote by looking tough. The international investor gets the high yield they were hunting for, and the actual stated economic policy of reducing the capital inflow achieves absolutely 0% of its goals.
That is a staggering realization to walk away with. The entire apparatus of sovereign financial defense, at least in the form of moderate taxation, is basically a hologram.
A complete hologram.
It looks real, but you can walk right through it. Which brings us to the present day, because this isn't just a history lesson about Brazil in 2008. These exact same dynamics are playing out right now across the global economy.
They absolutely are. The macroeconomic cycles of 2008 to 2011 are a permanent feature of the modern fiat system.
Yeah.
Whenever the U.S. Federal Reserve decides to breathe in when they aggressively tighten monetary policy and raise interest rates, the capital is violently sucked out of emerging markets.
And when the Fed breathes out, lowering rates and easing policy, the hot money floods back across the globe.
Emerging markets remain caught in this eternal siege, subject to the gravitational pull of decisions made in Washington.
And knowing what we know now, knowing that these price-based breakwaters are completely useless against the ingenuity of modern derivatives, and knowing that the market only truly respects the signal game we have to look to the future.
The empirical evidence from Jindrak, Noy, and Zheng forces a chilling question upon policymakers for the next global crisis.
What's the question?
When the next hot money tidal wave hits, will sovereign nations simply repeat history? Will they continue to build these useless, symbolic sandcastles of 2% and 6% taxes just to appease their angry domestic voters?
Or, realizing that the sandcastles are a mirage, will they be forced to make a much more terrifying choice?
Right, because if moderate controls don't work, a government really only has two options left.
They either surrender completely to the whims of the international signal game, allowing the macro tide to dictate their economic destiny,
Or they go to the extreme opposite end of the spectrum and impose total, draconian, ironclad isolation, effectively freezing capital accounts and completely disconnecting from the global financial system.
and total isolation carries its own catastrophic economic consequences. It's a devastating catch-22 for any emerging nation trying to navigate a globally interconnected world.
It really is.
The wall is a lie. The signal is everything. So the next time you see a headline about a country cracking down on foreign money or imposing new tariffs or taxes on capital, don't waste your time looking at the math of the law they just passed.
Look at the psychological signal they're desperately trying to send.
Because the smart money already knows the truth, and they priced it in 2 weeks ago. Something to think about the next time you look at your own investment portfolio. Thanks for diving deep with us.